So good evening, everybody. So glad that you could join us this Tuesday evening. My name is Jon Harris. I'm the managing partner, one of the managing partners with Fortune Management here in the Southeast. And one of the things that I've learned throughout my career is that it's a pretty good idea to be the dumbest guy in the room. And it's a pretty good idea to surround yourself with people that are smarter than you. So I have, over the years, learned enough to know that I'm never going to know enough. And so fortunately, I've been able to surround myself with very intelligent people like the three gentlemen that I have joining me this evening, and who have extensive expertise in a variety of different areas, all of which pertain to the topic of discussion tonight, which is inflation and capital gains. I know that's a high area of interest for a lot of people. So I'm looking forward to the collaboration and conversation to unfold this evening. Really looking forward to learning a lot. And so just some quick logistical points. We are recording this. It will be available and up on my YouTube channel once my graphic design team gets a hold of it and makes it look pretty. And then we will, anyone who attends live this evening, obviously we've got continuing education credits that we'll be sending out to those individuals. So please make sure that if you're interested in getting CE for the event, make sure that you do attend live. And outside of that, gentlemen, looking forward to the conversation this evening.
Yes, sir.
I could introduce you, couldn't I? We've got Mr. Matt Poppert down in the bottom right-hand corner, a good friend of mine and colleague in the dental transition space. Do a lot of transactions with him with respect to practice acquisitions and merger and acquisitions. Very intelligent, very experienced guy. Grateful to have him on with us tonight. Got Mr. Andrew Reipe with Crown Tenant. His area of expertise is in the commercial real estate space. And I'll flat out tell you, anytime I have a real estate question, I send it to Jason Price, who works with Andrew. And I'm sure Andrew probably gets some of those questions too. And so I don't even pretend to pretend that I know anything about real estate. As soon as a real estate question comes up, I just say, hey, Jason, what do I need to do here? I'll have my client text or call him because I don't think the truth of the matter is a jack of all trades is a master at nothing. So I know what I'm good at. I know what I'm not good at. So I try to stay in my lane. And then Mr. Lee Pennington in the upper left-hand corner, depending on how your display is set up, I'm not, maybe I got the corners wrong. But Mr. Lee Pennington in the upper left-hand corner is a dental CPA based out of Atlanta. We have a lot of mutual clients together, been working together for several years. Is a fantastic resource, wealth of knowledge in the employee side and the tax financial planning side. And so grateful to have him on with us this evening too. The only thing that I would change is the Georgia Bulldogs street sign in the back behind him there. But we'll convert him to Tennessee Vols before it's said and done.
Not going to happen.
We're probably going to have a winning season or two before that's going to be a possibility, but that's the plan. So, gentlemen, how are you this evening?
Doing well, thank you.
Great. Thanks
Very good.
for having us.
Everybody have a good start to your week?
Yes, sir.
Fantastic. Okay, good. So, obviously, the topic of discussion this evening is inflation and capital gains. And when we started, we were kind of talking about technology. Obviously, I think Andrew may have run into some complications. Matt ran into some complications with technology. And just as I've been, digging in a little bit more into this arena, I've read a lot of the arguments on both sides of the equation for, what our ultimately our strategy is going to need to be to counterbalance the inflation that we expect. And then obviously capital gains. And one of those is just the advancements in technology and how they allow us to be more efficient, how they allow us to be more productive. And hopefully even with information technology and the production of new goods and services so that we're actually creating more, in our economy, obviously is a key conversation there, a key element there to help counter the impact. But I assume we will, since keeping with the title of the event, inflation and capital gains, you guys want to tackle inflation first and dig in and see what we come up with?
Sounds good.
Fantastic. Let me switch over really quick to my notes. Okay, good. So I think there may have been not a typo. It was just a misunderstanding on my part or misperception on my part. But something I've been quoting here quite a bit recently is that 60 cents of every dollar in circulation right now has been printed in the last 12 months. After doing a little bit more research, that number is actually closer to 40. There are some reports that suggest it's as high as 60. There's also reports that suggest it's 20 or 30. But the bottom line is there's a lot of printed money in circulation right now. And obviously, when we print money, it induces inflation and it deflates the dollar. If you look at Zimbabwe, for example, there are 1 trillion and 10 trillion and $100 trillion bills of whatever the Zimbabwe currency is called. And 200 or 300 trillion Zimbabwe dollars could buy a cup of coffee. And what caused that impact was the Zimbabwe government needed money, and they just not knowing any better, I assume, just decided to print a bunch of their currency. And ultimately, over a period of years, now this is over a long period of time, but over a period of years, what's happened is it's manifested itself into basically a worthless currency that you could buy on eBay. So there are some very serious ramifications and consequences associated with that kind of strategy. Not to say it's the wrong thing to do, but as business owners, which a lot of the people that will be watching this are dentists, dental practice owners, CPA practice owners, transition company practice owners, we're business owners. Some of us own real estate. And so the values of our businesses, the values of our real estate are going to be affected. The values of our financial portfolios, our financial plans and strategies moving forward are going to be affected. And so I wanted to gather this panel of experts this evening to kind of dig in and talk about what are some of the considerations that we need to have, and what to do about it. If there is anything that we can do about it. So first and foremost, I'll present the first question here. And I'm not really sure. Actually, I'll probably present this question to Matt more so on the practice valuation side, because that's really your area of expertise. But inflation historically since 1926, if I'm not mistaken, has not exceeded like 1.3%, or not 1.3%, but what was it? I think the average over the last, since 1926, the average has been like 2.9% per year. Obviously, we've had periods that have been higher. We've had periods that have been lower. Right now, we're at about 5.4. But if you look at just the last 12 months, we've gone from like 1.9% to 5.4% in just the last 12 months, which if you look at the last, 100 years, essentially, that's a pretty significant jump. Okay. And so my question for you is what are you seeing in terms of valuations on the dental practice side? I know DSOs have a component, and just the market in general has a component, but with respect to inflation, are you seeing any kind of impacts in terms of practice valuations there?
Not necessarily at this point. Practices are still being valued based off cash flow, net income in the practice. So as inflation hits, you see cost of goods increasing. You might see fees increasing, but on actual valuations, I'm not seeing inflation necessarily affect valuations themselves. And I'd actually be curious if Lee, from the CPA side, if you're seeing anything or would expect to see anything with that based on inflation and evaluation.
Not currently. We're not seeing anything that's there. Ultimately, what we are beginning to see a little bit of is pressure from payroll costs, which are going to decrease the profits in the practices. And particularly if you're replacing a long-term employee, you may find out that you're going to have to pay significantly more to a less experienced person to replace someone that may be retiring or moving on or whatever they're doing. So we are definitely seeing that impact, but it is not increasing the value of practices at this point in time.
Yeah, and along those lines, that's actually a really good point. And I can point at a couple of examples where we had a hygienist that left the practice recently in the due diligence period of a transition that I was involved in the Brookhaven area. And they were able to find another hygienist to bring in, zero experience, but had to pay her $42 an hour to come in, which is very high for a inexperienced hygienist. And kind of along those same lines with inflation and just the employee pool, another practice that we're closing on here in a week, Amazon just came into their market. It's over in Augusta, and they had to increase a couple salaries of some long-term staff members because they were concerned that they may leave to go to Amazon because of the benefits and the pay and so on and so forth. So I do think that one of the things that's going to come out of all of this is, we're used to seeing staff wages in that 26 to 28, 29% range. And I think that those are going to steadily go up. And to your point, Lee, as those go up, it has a negative impact on the net income, and therefore it's going to have a negative impact on the valuation.
Certainly the cash flow analysis that we do when someone is looking to buy a practice is going to suffer, because the bottom line is how much does that practice produce for a new buyer coming in and being able to cash flow that out, cover their debt service, and do those kind of things. So we may see some impact in the future. I don't know how long out that's going to be, but I would expect that we will start to see some of that happening in the next few months.
Yeah, I completely agree. Those were my thoughts exactly. You've got supply costs are going to go up, equipment costs are going to go up, interest rates are going up. So financing that equipment is going to be higher. All of those things are going to negatively impact the bottom line. Cash flow is essentially what drives the value of the practice to begin with. One thing I'm curious about, if obviously cash flow is going to be affected, would you expect to see a decrease in valuations in terms of what the business itself is actually worth? And if so, money is going to be more expensive. So I'm thinking of several variables here. Money is going to be more expensive, plus cost of living is going to be more expensive. So what's the demand? Even though practice values are lower, is there going to be a higher demand to buy those practices, or are more young dentists going to say, listen, the money's too expensive. I know the practice is cheap, the money's too expensive, but I think I'm just going to keep my associateship here and wait until things change a little bit.
Yeah, that's a great question, and I wish I had a crystal ball to be able to tell you how it's going to eventually impact it. But I'll say this: one point that you brought up, John, was the cost of money getting more expensive. And to what Lee had said, when a bank looks at a deal, one of the things they're looking at is, can you cash flow the deal with the debt service along with the current living expenses that the buyer is going to have, right? So if a loan costs more per month, and that's going to reduce the monthly and the annual cash flow in the practice. So, it's going to be a little bit harder to fund some of those. So there's different ways, that you may still be able to demand that, maybe a seller note on the back end. There's some structuring things, but ultimately at the end of the day, we do rely on, and we need the banks to be able to finance these things to make them work. So if we go from right now, we're at ridiculously low interest rates. We're still seeing below 3% for practice acquisitions. A couple of years ago, we were hovering between 4.5 and 5, and still being able to get deals done, with where, the valuations currently are. Now, if that starts to creep up, that's going to have an effect on what type of a price a practice can command. But as far as, what's the mindset going to be of buyers coming in? A lot of these doctors that we're transitioning out right now were borrowing money back when they were paying 15%, and there were no DSOs out there, right? Back then, in the 70s, when those interest rates were really high, you were either an associate for somebody, which is radically different than associateships today, or you owned your own practice. And a lot of them own their own practice. So There is the option to stay, nowadays as an associate. Coming out of the pandemic, there was a big question of, are younger buyers going to be afraid to jump into this business ownership, because we had just went through, and we actually saw an influx of buyers that wanted to break away from associateships and DSOs and whatnot. So, dentistry is still a very, very profitable business to be in and to own. So even though maybe we go from a good practice having 40% net income, maybe it drops to 35. I don't know if that's really going to scare people away from buying a practice. It may give pause to some, but what I see in the market when it comes to independent young owner operators, there's still a lot of them out there that want to get in this game, and I think that it would take some drastic increases in interest rates to hinder that. And the banks seem to want to be able to lend to dentists. And maybe this is me just being really optimistic, but I almost feel like, banks might start looking at funding these things differently. Some of them offer 15-year terms already. You go to a 15-year term, even with a higher interest rate, your cash flow is still going to be strong. Just takes a little bit longer to pay it off, and it's a little bit more expensive. But at the end of the day, if the young doctor has the vision and knows how to grow that practice, it's still going to be well worth it. I'd be curious again what Lee's comments are, and even Andrew's, who's doing a lot of startups and has, a little bit of a different perspective on those doctors that are going out and just hanging their own shingle.
Yeah, I mean, I think the thing that we're seeing in the real estate side of things is more of an increase in labor costs and supply costs, right? If you're looking at what it costs to build a dental office 5 years ago, you're probably 30% higher today. Where costs of materials have gone up considerably. Again, labor costs, these contractors have been busier than ever building out offices. So I think that's where, I think you touched on the point in the beginning. And I think, from a purchase perspective, if obviously inflation continues to increase, interest rates go up, I think the rate of those increases are going to maybe dictate the impact, right? Because the commercial world does operate a lot slower than residential. But similarly, we've seen it be a very strong market across, office, retail, and medical office buildings. And I think, unless there's some drastic or inflation continues to rise and interest rates rise quickly, I think the market's going to be okay. But, I think when you think of it from since we work with buyers and tenants, when you think of things as a strong market, that word strong usually refers to the owner, the seller, the developer, right? Someone who's buying it. It's hard to source deals out there where there's deals, right? Those are few and far between because the low interest rate environment has continued to spur demand. So I'd say there's more demand than there's supply, kind of much like sure a lot of people are seeing in their own residential backyards, right? Where most of the markets we're in, that's still the scenario. Are there deals out there? Sure, right? But they are few and far between because there's a lot of money chasing those real estate deals right now, not just medical and dental. And I think the other thing to think about too, for those that are looking to purchase or development are, just like we talked about, increased construction costs, really make it today a better opportunity for purchase is to probably find something that's existing and try to retrofit into a dental office than to build from the ground up. Just with where land costs have gotten to and construction costs have gone to, the price per square foot, it's hard to make some of those deals work in today's market. So just a couple of things that I know is a little scatterbrained, but a couple of things that we're seeing kind of on the real estate and commercial real estate side of things.
Forgive my ignorance, but I know that how do I phrase this? There's several different things that the Fed does to kind of balance inflation a little bit. Like you've got some commodities, some industries, some goods and services that will experience higher inflation than others, and it's kind of like trying to balance this out over the whole economy. I would think that real estate would be not necessarily protected, but a little bit more of a secure type of investment, simply because there are real raw materials that are backing the value of that property. This could just be completely my ignorance, but the value of a piece of real estate, for example, can't fluctuate as significantly as the value of a piece of paper, I wouldn't think.
Or not, I mean, not as quickly, right? I mean, I think it
As quickly, yeah.
Yeah, for sure.
Yes, I would think that. I mean, I know everybody's kind of, me included, are kind of concerned about the housing situation right now, and are we going to see those prices kind of come down? And what if you just bought a home, et cetera? But I mean, now that I'm like thinking through this a little bit, I would almost say that real estate's a pretty, regardless of inflation, real estate would be a pretty secure place to put your money.
I would agree with you long term, right? I mean, I think, if you are a real estate owner and you've got the ability to operate your practice out of a piece of real estate, you're going to go through several ups and downs, several cycles through the course of your career, and nobody can ever time the market, right? So I still think the time in the market and building appreciation and equity in that asset that you're also operating out of can be a great windfall for a lot of practice owners. Absolutely. Totally agree with that. I think the challenge sometimes lies in the market that you're in and the cost of that real estate and the ability to be in the best location for the dental practice, right? In certain metropolitan areas, the cost of dirt is so high where, you could probably lease a space in a better location than own it. And then you kind of have to weigh in, well, what impact does that ultimately have on the dental practice, right? I think anytime as a practice owner, when you have that hat on, you got to think about what's best for the practice. And if you can marry the real estate with the practice and it's right sized and it can accommodate growth and it's in the best location to do the most dentistry, then that is a home run. Every once in a while, we'll see a couple of folks who kind of get caught up in the real estate side of things and kind of focus, in my opinion, too much on ownership of real estate versus ownership of practice. Because I will, over the course of a dentist's career, their best source or highest source of income is going to be the dental practice and not necessarily the real estate, right? So that's kind of things that we talk about with clients when we're going through the process, because we always want to keep practice number one. You can go buy and invest in a whole plethora of real estate, right? And if you're going to invest in something, put your practice in it, we want to make sure that that's the best site for your practice, given the type of practice that you have, right? Mm-hmm. That's going to allow you to produce ultimately the most dentistry over the course of your career. And if you can marry those two, and you can appreciate a piece of real estate and build equity and wealth over the course of the practice's life, then that is, obviously that's a tremendous opportunity that a lot of practice owners hopefully get to at some point in their career.
Yeah, I'm interested. Well, basically, I think the concept there would be that your real estate's going to appreciate in value. So even if inflation deflates the value of the dollar, you've got appreciation that's helping to offset the impact of deflation or inflation, at least to some extent.
Yeah, and I think, and even if you're in a situation, there's sometimes in certain types or products of real estate, I think of office condos in particular, that if you looked at historically, there's not as many of them. Their appreciation is very small compared to other sources of commercial real estate. But even so, you don't see major depreciation in those assets either. But if you looked at what somebody bought an office condo 20 years ago, yeah, there's going to be slight appreciation. But I think in those instances too, you kind of look at it and say lower cost of entry typically as well, easier to own, build. It's same model of building equity in that real estate. You just might not have the windfall or the mass appreciation that you might have if you were in a standalone fee simple product. So I think it does vary a little bit by asset class, but yeah, I think the goal obviously, or which you don't have control over, but the goal is to build wealth in that asset and hope for that appreciation, much like you do when you're buying into a stock.
Yeah. So I'm thinking because this is an area that I don't have a lot of expertise. I kind of stay very surface level, 100,000 feet. And so I'm looking at, how much does the money cost? Now I'm taking inflation into consideration. What's the interest rate that I'm paying? How fast is the asset appreciating in value? And ultimately, what's my net gain? So would I be on the right track if I was looking at saying, okay, let's say on average, the real estate, and obviously this is kind of future pacing a little bit, but let's say over the last 100 years, the average rate of appreciation is 4% on a piece of real estate. Okay, let's just use that as an example. Well, if my asset's going to appreciate in value or grow in value, much like a business at 4%, I'm making money until inflation exceeds 4%. And once inflation exceeds 4%, I know it's not dollar for dollar, but once inflation exceeds 4%, and now that's starting to cut away my gain. So, for example, where my mind's at is right now inflation's 5.4%. Last 50 years average, as far as I know, last 50 years average level of appreciation on residential real estate is 4%. So 5.4 minus 4%. Now I'm losing 1.4%. Is that kind of the general train of thought?
I've never looked at it that way or thought about it that way, but I think, that could be one way to think about it. But I also think again, over the course, I think you've got to look at what the average is going to be, right? You're going to go through down cycles and up cycles, and it's not going to be roses the whole way through. But the longer you're in it, the better opportunity to enjoy that appreciation over a longer period of time, for sure. Right. So, and I think obviously, like we touched on a couple of times here with interest rates being so low and money so cheap, obviously that spurred a lot of development and a lot of opportunities for folks to do some of these bigger projects and afford them, and where it makes sense to do it. And it's certainly within their budget and within, a market landscape of what one should pay for their real estate, if they were going to lease something or own it. I think that's the other thing that people sometimes don't really think about, that we try to educate clients on. When you're going to own a piece of real estate, you really want to make sure that what you're buying and developing and eventually leasing from yourself is in line with the market, right? And if it's not, at what point does it make sense or not make sense, right? You don't want to pay yourself $40 a square foot just to say you have ownership in it, when it might cost you $20 a square foot down the road, just to use a round number, right? You could have taken that $20 and invested in something else. So again, things to think about when people are buying real estate. It's got to be in the best location for the practice. It's got to make sense, and it's got to be a market deal or pretty darn close to it to justify it. Otherwise, does it make sense? Even if you can afford it, is it the best investment for you?
Yes. The reason I ask, and the reason I'm looking at it that way, is because I think the same concept applies on the practice value side. So let's say, for example, just an example, let's say I've got, and I'm just trying to make sure that I'm thinking about this the right way. But let's say I've got a piece of real estate that's worth $100,000, and historically I can project its appreciated value. It's going to appreciate 4% over the next 12 months, which would be $4,000. Okay. If inflation's 5.4, that's $5,400. So without inflation, my piece of real estate would have been worth $104,000. But inflation at 5.4% means that now my $104,000 buys 5.4% less. And so although I've got the $104,000, its real value is 5.4% less than it was. So I don't think it would affect the actual dollar number
but your dollar buys less
of the practice value. But a practice that's, making $400,000 a year now is very, very different than making $400,000 a year 20 years ago. You know what I mean? So the dollar amount may be the same. I still sold the practice for sold the piece of real estate for $104,000, but that $104,000 doesn't go as far now.
Yeah. Mm-hmm.
So, well, the reason
of what we get into with that whole scenario too, John, is part of the conversation relates to how the capital gains taxes could impact that whole scenario.
Yeah.
And if we are, as a practice owner, you're deducting something and you're in the 37% tax bracket during the years that you're deducting that depreciation on that building. That's how you're recovering your cost. But now when you go to sell it, we're talking about potentially a 43% federal tax rate when you sell it. The dollars are not matching up like they used to. I mean,
Right.
Yeah. So that back end capital gain is now worth a whole lot less to you as well.
Right. Right. Yeah, I'm really looking forward to getting to the capital gains portion, and really interested in getting Andrew's input on the real estate side of that, because there are some exemptions that people could take advantage of. Lee, you might be familiar. You're probably familiar with those as well. And so I want to make sure that everybody's aware of those. One of the reasons why I mentioned that, because just like a piece of real estate will appreciate in value a percentage over time, a practice will appreciate in value a percentage over time, right? So historically, the average rate of growth for a dental practice in the United States is about 2 to 4%. The challenge with that is dental inflation, the cost of doing the business of dentistry, has historically been 5%. So if you think about it, the average net growth of a practice is negative. And so this is just going to speed that up even more. So I think it emphasizes the need for several variables in the practice. So if you think about it, what's driving the value of the practice, which is ultimately what we desire to do, is profitability and cash flow. And so if you look at the major mechanics or mechanisms in a dental practice that contribute to profitability, is controlling variable costs. It's being in control of your fee schedule. So the more insurance driven the practice is, the less control of your fees you have. So in other words, when payroll goes up, we'll circle back to payroll, but when payroll goes up, you can't offset that by raising your fees if you're locked into an insurance relationship. So making sure that you're increasing your fees the appropriate amount each year, making sure that you're getting like a Clint Johnson to renegotiate or a Patrick O'Rourke to renegotiate your insurance reimbursements each year so that you're getting the highest possible fees. Your schedule, the way you schedule, and how you prioritize time in the practice, and then ultimately leadership and communication. Because in my opinion, that is the biggest area of inefficiency in a dental practice, bar none. There's in most practices, there's a lack of accountability. There's a lack of results that show up. There's ineffective or poor communication, which drags out the result that we're trying to achieve. So rather than growing 15% in 1 year, it takes us 5 years to do that. Right. And so I think enhancing the leadership and communication and culture speeds that up. If you can get the 15% in 1 year, now you're actually winning this game as opposed to losing it. Does that make sense? And I think those are really your biggest variables there. Can we let me back up real quick, because I want to spend just a second on payroll, because we kind of started our conversation there, but I think that's a pretty tricky place in terms of the rising costs of just doing the business of dentistry, because they're obviously, I think the article that I read said that on average, every dental practice across the country is operating with one fewer employee than it actually needs. So there is obviously a shortage of people across a shortage of talent for dental practice across the country. This is where I want to come back to the unemployment conversation, because if there's demand for talent and there's not enough talent, then the price of that talent goes up. Right? So that's the biggest line item expense in a dental practice. That's the biggest variable cost in a dental practice. And so if we expect that number to climb, obviously cost of living is climbing too. All of these things really point to deteriorating bottom line and the necessity to really focus on having controlling your variable costs, being very, very efficient and effective with your fee schedule, controlling your schedule and how time is prioritized and managed, and then ultimately culture, leadership, and communication. Those things are really the emphasis, the need to really be buttoned up in those areas is becoming increasingly important and will continue to become even more important as we move forward into these next several months and see actually how inflation is going to affect the practice. Is that a fair statement?
I think so.
Okay. And Andrew, why don't we back up real quick, because we were talking about how inflation is affecting interest rates. Interest rates are going to impact the commercial real estate markets. Inflation, we're experiencing now because of what we experienced 12 months ago, or roughly 18 months ago, right? So would you say just the general impact from from last April, May, June, the pandemic, would you say that the general impact of that is essentially the same? Are there differences there? Is it affected the real estate market in a different direction? Is it changing, or is it kind of a trend that you're seeing?
Yeah, so I think if you would have asked a lot of us last March, April, as we're kind of in the beginning stages of the pandemic, I think a lot of people felt like there was going to be a lot more fallout as far as businesses going under, vacancies rising, rents coming down, prices coming down. I do think the stimulus package really helped stave off a lot of that. And we've got dental clients that are in, retail centers, that are in medical office buildings, that are in pure office buildings. I'd say of all the sectors, medical office buildings kind of hummed along with nothing happened, right? The doctors and the practices continued to see patients for the most part, regardless of specialty, and have come through that glowingly. The retail sector was hit a little bit, but again, surprisingly, in most of the markets that we're in throughout the Southeast and Midwest, there hasn't been like an exponential increase in vacancy rates, right? And usually with higher vacancy rates, landlords are forced to reduce rents, increase concessions, things of that nature. We definitely saw some of that, especially early on, last summer, fall, where landlords were willing to provide bigger packages as far as free rent or TI allowances, things of that nature. And I do think, if anything, it has helped us from a negotiating power with our dental clients, where I think a lot of the landlords have started to think critically about their retail centers and some of their tenant mix. And where we've been telling them for years how valuable it is to have a dental client in their centers, because the average dental tenant or office will stay in a space about 7.2 years, whether it's that particular dentist or subsequent dentist through a transition. There's value in that, right? It's one of the best tenants that a landlord can have, because they're going to pay the rent every month, they're going to pay on time. I think the one sort of asset class that we don't know how it's going to quite shake out is the office space, right? There's been more, in Atlanta here, for example, there's more sublease space that's ever been on the market at any point in time, and more quality sublease space, where a lot of your big companies haven't yet returned fully to the office space. So they're trying to unload some of that, right? So landlords haven't quite, the commercial real estate cycle is a longer cycle. It's the last thing to kind of get hit. We saw it coming out of the Great Recession, where some of the immediate impacts weren't felt. It was kind of a trickle-down effect. And so I think we're going to continue to see some of that that might depress rental rates and things of that nature. But I think if anything, I think it's kind of shed some light on the fact that as a dental tenant, when you're leasing a space, you do have a lot of leverage in that. You are it is one of the tried and true businesses that is, I won't say fail-proof, but consistently, it's a great business to be in. And does historically, the lenders have been telling me for years, is one of the lowest default rates on loans and leases of any industry that there is. So that being said, I think overall in most of the markets, have certainly stabilized, right? I mean, in the Southeast too, I think we were probably less impacted than other parts of the country because the government didn't mandate lengthier shutdowns. So I think if you were in the Northeast or some of those other markets, for example, it might be a little bit of a different tune. So I think in most parts of where we're operating in the Southeast and the Midwest, the markets have pretty much been pretty stable as far as rental rates. I would say, if anything, we've seen probably a little more aggressive improvement packages and free rent packages and concessions that landlords are willing to offer. But all in all, it has been nothing like we thought it could be coming out of the pandemic or at the start of the pandemic of what we thought might be forthcoming.
Yeah. So a question for you, because I know, like, I just purchased another home. I'm fixing to rent out my existing home, and I'm looking for the other properties that are available for rent, and there are none. And so what my real estate agent's telling me is that the rental market right now is on fire. Like, what you can charge to rent a residential property is through the roof, right? Like, I can technically rent my existing house out for what the mortgage is on my new house. So that's exciting, as the landlord. However, on the commercial real estate side of things, I can't remember who I was having this conversation with, but they were essentially talking about large commercial buildings that have, like, one company rents out like 5 floors, but now you've got all of these employees who are working from home now rather than coming into the office.
Yep.
And so now the demand on that space has now gone down. Is that what we should expect in terms of rental rates and lease rates?
I think certainly in that sector, and again, I think we're kind of at the beginning of that, of them really being impacted, because even though that they haven't returned to work, usually those companies are signing long-term leases, and unless that lease happened to end at some point after the pandemic, and now they've still been making those rent payments. So the landlords haven't quite yet felt the crunch. But I think where they're starting to feel the crunch is where they do have vacant space. A lot of office tenants are choosing to go into sublease spaces for cents on the dollar versus paying a landlord what they think the market is, and they can beat a comparable space. And I think that's a little bit different than what we've ever seen before. Just the amount of companies that are, to your point, employees aren't returning to work, or certain sectors of their business, they're thinking maybe we'll do remote, or we'll do a hybrid schedule for the near future, the foreseen future. So we don't, instead of taking 5 floors, maybe we only need 2.5. So now you got 2.5 floors that tenant's willing to sublease, meaning they'll take 60, 70 cents on the dollar potentially, right? And a landlord's not going to be able to compete with that particular sublease per se usually. So when they have to, then they're going to be in real trouble, right? If tenants leases roll up and they're used to paying $30 a square foot, and they can go down the hall and sublease the space for $20 a square foot, landlord's going to have more vacancies, right? And going to have to compete and figure out a way to compete via, more concessions to new tenants, lower rental rates, et cetera, et cetera, et cetera. So we're starting to see that. I mean, I think it's going to be interesting to see how that continues to play out probably over the next 12 to 18 months. But, for our folks that are in retail centers and medical office buildings, those opportunities right now, as far as a tenant goes, yes, there's still deals out there, but it's not a fire sale like we saw in 2009, 10, 11, as we were coming out of the Great Recession, where we were doing crazy deals. And I've had a number of clients that I went through that with, and coming up for lease renewal, and we had pre-negotiated rental rate language in there that in some instances are $5, $6, $7, $8 a square foot less than landlords are getting today in those centers. Mm-hmm. Right. And it's, again, like we talked about, you can't, it's sort of like being in the stock market. The longer you're in it, the better your odds are, right? We all want to get out on top, or everyone wants to make money, but you're going to have opportunities that you can't predict, or you really can't foresee. And if you can do the best, I think, as a business owner, to take advantage of them when you can, and when you can't, then you just try to get the best that you can, just knowing that the longer that you're in business, the more opportunities that you're going to have, and you're going to go through these cycles. And you can't time the market, right? And some of these things, who would have ever predicted that we would have gone through a pandemic, or the bottom would have fell out the way it did, in the Great Recession. So I hope that answers the question, but I think, I think you make a great point. I definitely think that there's definitely going to be some pain for some landlords coming, certainly in that pure office world, where we do have dental and medical, but I would say the medical office buildings have still been trading at record highs, still been, high occupancy rates, as well as a lot of the retail centers in the good markets.
So, hey, John, let me just kind of plug Andrew with what he's saying. So you were talking earlier about controlling costs. And, the second biggest line item on your P&L behind employee wages is typically your real estate expense. And having a guy, my advice to anybody out there that's listening to this is if you're currently in a lease situation and you're thinking about renewing a lease or you're thinking about buying property, having somebody like Andrew negotiate those deals for you who understands, what the difference is going to be with a MOB versus, a retail center, and allowing him to be able to negotiate that with what we're seeing going on right now. To kind of piggyback what Andrew was saying is you can find some things that are much more aggressive than he could a year and a half ago when the inventory for retail space was, very, very low, especially in larger markets like Atlanta and Nashville, Knoxville, so on and so forth. But he can help reduce that and negotiate better terms because he understands what's going on out there. So as your employee costs are going up, if you're coming up on a lease renewal, having somebody like Andrew even negotiate that renewal for you can eventually lead to possibly saving some significant money, as well as maybe getting some TI dollars or something along those lines. And if the seller or if an owner is getting close to transitioning or at any point when they're negotiating a lease, one of the things that we've run into, and Andrew's actually been involved in a couple of these that we're working through right now, is the assignment language that's not clearly drawn out can create a lot of havoc in a transition. For example, we had a client up in Franklin, Tennessee, a few months back that did not have really good language for an assignment lease written into it. Didn't have it locked down what exactly would happen. Long story short, the landlord came back and said, sure, we'll assign this lease, but it's going to cost you $75,000 to assign it. Now, we ended up negotiating it down, but it was still a very hefty fee that seller ended up paying. But had they had somebody like Andrew and a good dental attorney to review that assignment language, that could have been avoided. And we've run into other situations as well. So having a professional like Andrew involved in something like that understands not just real estate, but understands how the dental world works. And if there's somebody out there that's listening that's 35 years old and says, oh, I'm never going to have to sell my practice, or I'm not going to have to sell my practice for a long period of time. Listen, I've transitioned practices from doctors from anywhere from 38 years old to, 78. It happens. Things come up and you have to transition. So not taking advantages of the services of somebody like Andrew that represents tenants and buyers can be drastic, not only to your P&L, which, I know Lee can attest to, but also from a transition standpoint, when you're ready to transition and get out of that, what that ends up looking like or how painful it can be from a lease standpoint.
I appreciate that. So
I would add to that, I think anybody that's looking or has a lease in particular, they should be looking 2 to 3 years ahead when they need to make that lease thing. So it's never too soon to have that contact and just have it that rapport established and know where you're going to be. And I would say no less than 2 years out, you should be working with someone like Andrew to evaluate what's going to happen at the end of that lease time. The worst thing that can happen is you can get it inside of a year and you don't have time to do what you need to do at that point in time. So that's very important.
So I'd say the earlier you establish that connection relationship, the better position it gives Andrew and his team. And the more leverage it gives them to create an outcome that's more beneficial.
Yeah. Right. And to plan too, right? Depending on what the practice's goals are, if it's something where you've thought about ownership, then we may need 2 years if it's going to be a ground up development for sure. And if it's not, we still want the time to go look at everything, come up with a plan, parallel process, run buy versus lease analyses for you, help you understand what the full ramifications are, whether you're going to stay in the same location or relocate. The more time you have, the better. You can always slow things down It's very hard to speed other people up. I always say, so I'd rather, it's much easier to pump the brakes than get someone to do something later on down the line. So, I would say absolutely 2 years. We offer complimentary lease reviews. Love to kind of go through those things ahead of time and start that process. And it does allow us to create the leverage with landlords so that they understand that you're not 6 months from a lease expiring and probably aren't going to relocate because you haven't thought about it until now. And even if you are going to stay in place, having the time to have those conversations and game plan and look at other market options only creates more leverage with us when we do negotiate. So oftentimes I think people look at real estate as just, it is what it is. It's a necessary evil. I've had some great case studies where I've had clients who are in long-term leases who didn't realize what was going on in the market because they were wildly successful and market changed. And one in particular, we literally went back to the landlord, restructured his lease and saved him about $350,000 in cost avoidance over the next term of his lease extension. And he just couldn't believe it. He just kept asking me seriously, what's the catch here? And there was no catch. The catch was he was in a bad lease, right? It didn't necessarily impact him because again, he was wildly successful, but I think he was, at that point, I think he was certainly probably thinking to himself, how much money had he potentially overspent certainly for the last several years if he didn't restructure this earlier. So, it's never too early to look at these documents and then plan accordingly. Matt makes a great point about some of the other things that go into a lease. Obviously, we always want to talk about the financial impact of it, but there's a whole plethora of lease jargon and lease sections that can really potentially become major factors if they're not mitigated from the start, such as the assignment language. At some point, there's a high level that the dental practice is going to transition, and having the ability to do so unencumbered by a landlord is critical, right? You don't want to get that surprise message from a landlord that all of a sudden they want to try to hold you hostage and create a windfall for themselves because they don't have to agree to transfer the lease and transfer the space. You want to get that ironed out up front. And that's just one example, renewal options, things like that, making sure there's no termination clauses or relocation clauses. So there's just a lot that go into it if you haven't gone through it before that, just to do it right the first time, even though you're so excited to get into business and you're not worried about 10 or 15 or 20 years from now. It's just important to make sure that you're mitigating risk as well as getting the best financial deal that you can when you're signing a lease or opening a practice.
So with all that said, I know this isn't as straightforward as it seems. Obviously, if you buy real estate, then you have the opportunity to build equity on your balance sheet. If you lease real estate, then you are building equity on someone else's balance sheet. However, there is a very real cash flow conversation to be had too, because I've got a client who got a steal of a deal on a practice acquisition, and her lease is, like 1.2% of the practice's revenue, where typically you'll see rent somewhere between 4 and 6, and even as high as 8. That difference in cash could be reinvested in the practice to have the practice grow faster. It could be taken as income or a distribution and invested in the stock market where you're getting a higher return. So there is a cash flow conversation to be had there too. So with inflation, obviously capital gains coming up, with all that stuff taken into consideration, Andrew, would you say that the market for buying or leasing seems to be more attractive at the moment?
Really depends on the market and the submarket. A lot of our clients that are outside large metro areas, the cost of land's cheaper. Construction costs may be a little cheaper. Those are usually slam dunks. I think where it just really depends if you're in a major metropolitan market and land prices are significantly higher, just modeling out those costs and figuring out what makes the most sense. And I tend to just kind of go back to that example of, think about the practice first. And if ownership is the ideal and you're in Buckhead, for example, where real estate's the highest in the state, rental rates are high as well. Can you find something to own? The answer is probably, right? probably can, but what's the cost to that, and what are the options, right? So it's kind of a case by case. It really is. We again, I just can't stress it enough. It's we want to make sure that the real estate supports the practice, right, and making sure that the location that you're in, is best for your particular practice. If you're a specialist, maybe you can go own something three streets off of Main Street and have zero impact. But if you're a general dentist or a newer doctor, your ability to buy something in a location where you may need to be to gain the patients that you're trying to serve might be different from that specialist. So, I think certainly, like you said, with interest rates being low, it is a good time to buy real estate. We are seeing some higher prices and some higher valuations, but I do think overall, if you can get into a location and that facility is going to accommodate you for the foreseeable and long-term future, right? And it makes sense from a cash flow and a production perspective. Absolutely, it can be a great vehicle. It obviously gives you control, builds equity and long-term wealth and appreciation, and obviously there's tax benefits to doing it as well. So the long and the short of it is I can't say it's for every practice. I think it's kind of that case by case of where the practice is in their career. I think we probably, ironically, for whatever reason, the past 12 or 18 months have some of the larger purchase transactions that we've done with kind of I guess you call it kind of the mid-career or the dream practice where that practice or doctor's been practicing for 10 to 15 years and has the ability to build that practice and to have that ownership and not feel a pinch or a change cash flow wise based on what their facility costs were. And now they have the ability to build their own building and be their own landlord and build that equity and take advantage of all the things we've been talking about. So I don't know if that answered the question 100%, but certainly, yeah. I mean, if ownership is, I think real estate is a good portion. Whether you own the facility you're in, but you're probably going to want to be diversified and have some real estate ownership, whether it's your home or whether it's a rental, or hopefully at some point people do have the ability to at least consider ownership of their for their practice, because it's a facility cost that they're going to have to pay it, to somebody else if not themselves. So,
yeah, and I think that's kind of that was my kind of general thought behind it. Is if it's a long-term acquisition, then the property is going to increase in value over time. So even if the market drops a little bit, you're probably going to make that up over the life of the property, and then some. So you're still going to have an upside there. I guess one of the things that I'm concerned about is if we're going to see, the demand, if we're going to see the supply on commercial real estate availability and lease space stay where it's at now, but the demand go down, like the example that was provided earlier, where I used to have 5 floors, now only need 2.5. Right. So now we've got more supply than we've got demand. The cost of that lease comes down, which means more cash flow. I can get the same amount of square footage for less money, which means I'm more profitable. And then obviously that translates into other real tangible benefits. So, okay.
Yeah. I think the one thing too, I guess to keep in mind too, is when there are corrections, like I think about the Great Recession, we were in a recession, right? So how were those practices impacted, right? Obviously the real estate was cheap, but as things have gotten more expensive, those practices now are doing what percentage higher than they would be doing in 2009 or 10, right? Depending on what type of practice you have, but I think the economy has been just chugging along, right, so well that people are also spending money on procedures that they might not have been if we were in a recession, where things are cheaper, things are cost less, but I'm also producing less, right? So I think we're kind of on the other side of that, where things are more expensive, cost of money is cheaper, but there's also a lot of demand for things too. Right?
Yeah. Is there a general rule of thumb there, or is there a ratio that you use, or maybe Lee, or maybe even Matt, where, okay, I need X amount of square footage. I can buy a piece of real estate, has that square footage. This is the mortgage, and obviously I own it, versus I can lease it for potentially less. Is there kind of a general rule of thumb there that says, hey, it makes more sense to lease in this scenario than it does to acquire? Or, because in my mind, I'm thinking it's always going to be better to buy, but that can't really be true simply because there are people that would disagree with that statement. Right. Right. So there's got to be an argument for the other side of the equation.
Well, I think Andrew probably speak a whole lot more to that, but from my perspective, when we're looking at the cash flow, if you're buying a practice and you want to own a piece of property in Buckhead and build a building, that may be a whole lot more expensive than leasing a space. May or may not be,
Yeah.
So I don't think there's a general rule of thumb that you got to go to from an accounting tax standpoint. And what we look at is cash flow is the most important thing. It has to cash flow out to the owner so that he can cover his debt service and make a living that's suitable to what he needs to make. Yeah. And the banks look at it the same way. So getting the financing comes back to that same issue oftentimes as well.
Yeah. So I think the answer there is you're going to have to do the math. Yeah. Each scenario is going to be unique. You're going to have to do the math, and you're going to need to consult your CPA for the depreciation and the taxes to know what the impact there is going to be. And probably even your financial advisor needs to be a part of that conversation. Someone like Andrew would definitely need to be in that conversation. So you need to get a panel of expertise there to help navigate some of those variables to see which, in each particular scenario, which option is going to make the most sense.
The other thing you've got to take into consideration is what is the value of the real estate going to eventually have on when you're selling the practice. So, for example, if you've got a $800,000 a year practice, a practice is collecting $800,000 a year, and you own a piece of real estate that's now valued at $2 million. It's hard to sell a $2 million building when you've got a practice collecting $800,000 because your net income is probably going to be in the $300,000 range. So to try to get a practice like that to be able to cash flow, that's very, very difficult. The other thing is if you're in an area like that where you've got a building that might be valued that high, if you're going to charge a lease rate that is comparable to what a building like that would lease for, it's going to have a negative impact on the cash flow, which can make it difficult for a bank to sign off on, or for somebody like Lee to sign off on too, because it's going to eat so much into the cash flow. So it's important. We've had these scenarios where practice will be in a gorgeous building that's valued very, very high, but they can't, they have a really difficult time on the real estate side because the lease rate that they would need to charge is impacting the cash flow very, very sharply. The flip side of that is you say, well, I plan on selling to a DSO and they've got deep pockets. Well, everything with a DSO, the valuations are all based off of EBITDA. So if you say, well, I want to charge, $10,000 a month in rent, they may be able to do that, but what it's going to do is devalue the practice when you do that. So there's a process of finding that sweet spot there to make sure that it's going to be equitable down the road when you've got a piece of real estate, that it's not going to hold up the transition of your practice, or it's not going to, quite honestly, devalue the one or the other, the value of that real estate. Because the flip side of that is you say, okay, well, I'll charge this buyer $6,000 a month in rent to be able to make the numbers work, but then I'll find an investor to buy it. Well, an investor is going to buy it based off of an investor buys it off a cap rate. And Andrew, you tell me if I'm missing something here, but typically they want to see cap rates in the 6, 7, 8, 9 range. Well, if you have to lower that rent is what is going to be, that cap rate's going to be based off of. Again, it's going to devalue the real estate. So there's a little bit of a balancing act there that needs to be thought through ahead of time as well. So again, having having a good real estate guy like Andrew and a good CPA like Lee be able to take a look at all of those things and start projecting out what's that going to look like, so you can best plan for yourself down the road. If I buy this real estate, what effect is it going to have on my portfolio long term with the information that we have today? Because none of us have a crystal ball. We don't know what's going to happen, but you do have to plan accordingly to that. And sometimes we do find where we have real estate that's more valuable than the practice, and it can become a little bit of a challenge as to where we're going to put our efforts and our resources.
That's a fantastic point. That's a mistake I see a lot of people make. They go out and get the whatever amount of real estate that the bank will finance, and it's a lot bigger and a lot more expensive piece of real estate than what that practice actually needs, and technically what that practice can sustain. So in the example that you just provided, they've got like a $2 million piece of real estate, now $800,000 practice, and it definitely impedes the cash flow, which is hurting the valuation. But if he's wanting to, so they need to have a budget going into that conversation. Like, for example, if he's in the middle of nowhere and there's not merger acquisition opportunities, available to where he can buy and fold practices in and elevate his revenue and grow into the building that he just built, he's kind of put himself in a pretty difficult situation to get out of. But if there are abundance of those types of opportunities and he's a more progressive type of entrepreneur and he's going to, leverage those, then he's probably got a really good chance of growing into the space that he's acquired. But I would probably want to see somewhat of a track record and see a trend and that doctor headed in a particular direction before they take on that kind of a investment. Cause that would be a pretty risky move right out of the gate. I've seen that happen on a number of different occasions. And every time that I've seen it happen, it did not work out very well at all. And it's because the payment on the real estate eats into the profitability so much on a young practice, they can't reinvest in the business the way they need to get that growth, to get them to where they are fully utilizing the real estate. So that's a fantastic point. I do have a question.
Further to Matt's point is this, and that's probably the number one area that we see when we're evaluating a practice for a buyer, is when the practice owner owns the real estate. Mm-hmm. That's where we typically wind up with the biggest negotiated adjustment to the rent that the owner is charging himself. Since he owns it, he can do it. But he's charging $10,000 for a $4,000 building. And they have to adjust their expectations very significantly on that.
Yeah. So I do have a question that I want to present. But before I do that, I wanted to ask Lee a question really quick. When you have scenarios like that, I'm vaguely familiar with this, but I'm not 100%. I know you can depreciate goodwill over one period of time. You can depreciate real estate over another period of time. Mm-hmm. When you have transactions like the one that Matt just described, where you've got the practice owner who owns the real estate and the practice, and you see where they adjust the value of the practice to give the buyer, the seller, more on one end or the other. Do you see that number move? Is it just, this is what it's worth, this is what I'm paying, these are where the numbers are being allocated? Or do you see in certain transactions where we adjust those numbers for either depreciation purposes or tax purposes or whatever?
Not too often. The practice is what it's worth, is generally speaking, what it's worth is what it's worth. And when you get into transition things, the old adage is, it's what a willing buyer and a willing seller are willing to agree to. Mm-hmm. And that carries through in all parts of life, whether it be real estate or whatever we're doing, So we don't see a lot of those adjustments, but we do with the real estate. Again, back to the point I just made, it's that adjustment of the expectation on the seller. Certainly, he's moving dollars from one pocket to the other. He's putting it in his real estate pocket by charging $10,000 a month for a $4,000 building. The buyer is not going to be able to pay him that and make it make sense from a cash flow standpoint, because the seller didn't have debt service, most likely, that now the buyer has. So that's the area where it gets adjusted. It's a negotiated part of the agreement, and it comes down to something more accurate to what the fair market value is. Andrew's company has helped us with, helping determine that at some points in time. And I know he works on both sides of that transaction oftentimes too. So there's a deal there. And Matt helps with that a lot too, and helping his sellers understand that they've got to make some adjustments to their expectations for that.
Very good. So there's a question that came in from Dr. B, who was asking what percent are practices currently selling at? I'm assuming that means like percent of collections. And then what percent, I see Matt smiling, and then what percent are banks lending at? So I do know that banks are lending 100%, 100% financing on practice acquisitions. You can get that at First Citizens. I think B of A is doing that. Wells, I think Wells shut off their small business lending at the moment, I think. As far as the practice, what percent the practice are selling at, I think that's a misconception because the valuation is actually a multiple of EBITDA. They don't like go in and say, okay, the practice is collecting $1 million. I'm going to give you 90% of $1 million. I'm going to give you 900,000 for the practice. That's not how that number comes about. That number is created as a derivative of some multiplier like 2.2, 2.5, some multiplier times the practice's cash flow or EBITDA. And it just so happens that when that number is calculated, it comes out to be a percentage of collections. So it might be 110%, it might be 90, but you could have a practice. How do I phrase this? You could have a practice with $500,000 of EBITDA that's collecting $900,000, and a practice that has $500,000 of EBITDA that's collecting $1.2 million. So the valuation of the practice is going to be the same, but obviously it would be over 100% of the $900,000 practice and probably close to 100% of the $1.2 million practice. Matt, does that sound about right?
Yeah. When it comes to, owner operators buying a practice, so a young doctor that's buying their first practice, the valuations are based off the cash flow, the net income, or what we refer to as the seller discretionary earnings in the practice. So, there's the rule of thumb out there, which I think guys like Lee and myself, when we hear that, what percent should I be paying? It gets frustrating because at the end of the day, it's about the cash flow. You're buying a revenue stream. So, John, if you remember the deal we worked on in Buckhead together last year, the net income in that practice, the overhead in that practice was only 45%. So, let's just make the numbers easy. If you've got $1 million practice that's putting off $550,000 of net income, and you've got another $1 million practice that's putting off $250,000 of net income, you don't expect to pay the same price for both of those practices. So, you're going to, that practice in Buckhead ended up selling at 115% of prior year's collections, 113%. But essentially, you're buying a practice that you typically expect to see that type of cash flow on a practice that would be collecting, 1.4, 1.5 million. So you're paying for that cash flow essentially when you're buying it. Now, when you're talking about an investment opportunity where you expect a DSO comes in or a practice owner that's buying another practice and they need that practice owner to stick around for a couple of years, those practices are typically valued at a multiple of EBITDA, which is going to be different than your cash flow, your net income or your seller discretionary earnings. The seller discretionary earnings does not take a salary out for that owner operator. That's all left in the discretionary earnings. When you're looking at EBITDA, it's essentially your seller discretionary earnings. You're adding back your depreciation, your interest, your taxes, depreciation, amortization. That's all getting added back in. But then we also have to calculate and say, okay, the doctor's producing $600,000 of dentistry. We have to pay that doctor, because we're investing and somebody else is going to be doing that. We have to pay them 32% of their collections. We've got to take that out of that seller discretionary earnings. So you could have seller discretionary go from 500,000 maybe to 250, and then that 250 that's left over, that's the EBITDA in the practice, and then they'll take a multiple of that to come up with their valuation. And then there's a whole other conversation about, well, how is that structured? Because typically when an owner operator is buying, they're bringing all cash at close typically, right? So if a $1 million practice, say it values at 800,000, it's the bank's gonna give them 100% of what that's valued at. But to the question that you had asked, how much are the banks lending up to? They're typically going to lend up to 80% what they call loan to gross. So if a practice is collecting $1 million and the valuation or the purchase price is 80% of that, they'll lend 100% of that. Now, if the valuation or the agreed upon purchase price ends up being more, the bank will take a look at that. If there's really strong cash flow, sometimes they'll still do that deal as it is. If they don't, what the bank will do is say, we're fine funding this. However, the additional $100,000 that's been negotiated on the purchase price and the $100,000 they need in working capital need to be held in a seller note. So the seller then takes a secondary position on, say, that $200,000. A lot of times in the contract, they'll put language in there that, it can balloon after 24 months or 36 months or something to motivate that buyer to go back and refinance it. But essentially what the bank is saying is we need this buyer to get a little bit of experience under their belt. And we want to kind of keep the seller engaged in that practice to make sure that goodwill is being transferred because they're paying a premium in that scenario. So that's a really long way of saying, and then back to the DSO thing, if a DSO valued a practice at $1 million, they're probably coming to the table with 800,000 of that. And then 200,000 is either going to be structured in some type of an earnout, a seller note, or possibly an equity roll. And there's a number of different things that have to be taken into consideration in those. But your valuation is typically going to end up higher when you do an EBITDA calculation, when it's an investment versus an owner operator. But there's more stipulations on those DSOs. And that's where it becomes very important to have a broker, an attorney, a CPA looking at those things that can really pull those things apart, peel back that onion to make sure you fully understand that, yes, they're valuing this at $1 million, 120% of your collections, whatever that may be. But how do you make sure you're getting all of that? Because when it comes to the closing table, you're probably only getting 70 to 80% of that up front. Now, circling all the way back around, what's the rule of thumb right now? If you're in the greater Atlanta area, valuations from an owner operator standpoint are high. We're seeing valuations come in, between 75 and 85%. And we sometimes are seeing these practices sell at even a higher margin than that because things become competitive and you get into bidding situations, much the same as the residential real estate market right now. If we've got a halfway decent practice in the metro Atlanta area, it's going to sell for a premium. If we have a good practice in the metro Atlanta area, it's going to be a very competitive situation for buyers. And it's going to sell at an even higher price point. The supply and demand right now is just in the Atlanta market. The supply is low and the demand is high. You get into a rural setting, and if we've got buyers on this call right now, I would encourage you to look at practices that are a little outside of a major metropolitan area. It's going to be less competitive from a buyer standpoint. Typically, those practices are some of the most profitable I've ever seen because the two highest line items, like we were talking about earlier, are staff wages and real estate. Both of those are typically less as you get further away from a major metropolitan area. So instead of paying $42 an hour for a hygienist with no experience, maybe you're paying $28 to $30 an hour for a hygienist with no experience. Real estate in Buckhead, I mean, it's obnoxious what you're paying, 60, 70, $80 a square foot, I'm guessing, Andrew, where if you're in Carrollton, Georgia, you're probably going to be in the 18 to $20 a square foot. That's a huge difference. So those practices typically tend to be more profitable. As a buyer, you don't have as much competition. real estate typically becomes part of the deal because it's much more affordable. Typically those practice owners are going to own that real estate for obvious reasons. So I don't know if I answered the question, but at the end of the day, they're still valuing high. It's not about the percent of annual collections that you're paying. It's about what's the cash flow that you're getting, and are you buying that at a fair price point? Is that fair, Lee?
Absolutely. You want a job? You did a good job explaining that. So it is definitely about the cash flow, how it goes. And, can't overgeneralize things. And I would say that a couple of years ago, we would say that it was at 85% in Metro Atlanta. It's probably a little bit more, 80% now. Seems to be where more what the banks are willing to do. But it's 100% of the asking price or the valuation price, not 100% of the collections. And I just want to be sure that people do understand it's not 100% of your collections typically.
Very good. Okay, let's shift gears a little bit. We've got about 35 minutes here to cover capital gains. It should be fairly straightforward. But essentially, for those that aren't as familiar with capital gains, you've essentially got long-term capital gain. If I say anything wrong, you stop me, correct me. But you've got two kinds of capital gains. You've got long-term capital gains. You've got short-term capital gains. Long-term capital gains are typically taxed at either 0% if you make less than $40,000 a year, I think, 15% if you make between $40,000 and $400,000, and 20%, I think, if you make over $400,000. So we are going to have some people, some owner-operator dentists who are in that middle category, which covers the vast majority of people, and we're going to have some that are in that 20% category. And long-term capital gains are any realized gain that happens after 12 months and 1 day. Short-term capital gains are within the first 12 months that you've owned that asset. And you're typically going to be taxed on short-term capital gains similarly to whatever tax bracket you fall into. So based on your income, you're going to fall into a tax bracket. If you have a realized capital gains, capital gain within that 12-month period of time, and you sell the asset or close your position, like for a brokerage account, for example, if you bought it at AMC at $9 and you closed your position at 72, and you had a short-term capital gains in a 3-month period of time of $75,000, you're going to be taxed on that $75,000 based on whatever your income tax bracket is. Lee, that sound about right?
That's absolutely correct. Yes.
One thing that I'm really, really concerned about on capital gains is the concept of unrealized capital gains tax. Are you guys hearing about this?
Yes.
It's a concept floating around Washington that 10 years ago wouldn't even have been a part of the conversation. And now, because of the debt issue, because of the spending limits, because of now what is it? Not inflation, but the stimulus money that we've sent out, we're digging too big of a hole. And so they're looking for creative ways to get out of the hole. And one of the ways to get out of that hole is now the idea that they can tax unrealized capital gains. So if your IRA appreciates in value or grows in value, 7% over the next 12 months, the idea of unrealized capital gains is that they can tax you on the 7% gain, even though it's not a realized gain. You didn't actually put money in your pocket, but your portfolio grew 7%. Because it grew 7%, you now owe us part of the 7%. Does that sound right?
There's a piece of that. It looks like there will be some exclusions based on different things related to that. Unfortunately, when you start talking about tax policy, you're really talking about politics. There's very much tied into that as well. And it's going to change based on who's in control of Congress and who's in the president's office and those kind of things. There's a lot of things that have been discussed about in regards to tax policy that the Biden administration has kicked around. Some of that they've backed off of. Some of that they seem to be pushing. A few months ago, when he was on the election inauguration time, I thought that would probably get pushed through pretty quickly. As we went through a lot of the things in the early part of the summer, I felt like politics was pulling back from a lot of that. Even some of the Democrats were scared of some of the policies that were being introduced. And now it seems to be gaining some momentum to go forward. We don't know what will happen. It comes to that crystal ball situation. But there are a few things that have been kicked around. We don't know what's going to happen. That's the unfortunate part. We're sitting here and trying to figure it out. It's much like what we went through last year with PPP and a lot of other things, trying to figure out what would happen. And it changed on almost an hourly basis in many cases. But what you said is very scary. The question that if you look at tax policy, okay, next year my portfolio goes down 7%. Are they going to refund the taxes I paid last year when it went up 7%? You know, so there's a whole lot of things that we don't know right now and don't know how that would come to be. Capital gains rates will, in many cases, exceed ordinary income tax rates. If you have a substantial income, capital gains rate would be higher than what the highest tax rate would be at 37.9% versus 43.9% on the capital gains side. So you get into a whole lot of things there. You know, historically, we've been able to deduct depreciation, for example, on a building at whatever tax bracket you were in. And if you were fortunate enough to own the real estate, you were probably deducting that somewhere at a 30 to 35 to maybe 37.9% rate. And on the back end of that, when you sold the property and you recaptured all that depreciation and so forth, it was a capital gains, and you paid it at those lower rates that you spoke of, which would typically, in that case, for somebody be 20%. So there was capital created that someone could go out and reinvest in the economy, create jobs, create other opportunities. With the current scenario, that's not going to be that way. It's actually going to cost you more to sell it than it did when you were deducting it. So I don't know what the impact of that will be. It may be enough to flip the switch on some decisions. Certainly, I think it would be as to when you buy versus when you lease. Those things, you know, Andrew, unfortunately, those are some things that we're both going to be facing in what we do as we look forward to advising clients.
Yeah, we don't quite know. We know that there is a push in Washington to raise capital gains. We don't know quite what that rate is going to be. I don't think it's going to be quite as high as what was originally introduced.
Right.
But it's certainly going to be higher than what it is now. And so one of the questions that I've got is, this, I guess, first question for Matt is, are you seeing because the idea that capital gains is going to go up, are you seeing that incentivize more sellers to go ahead and transition their practice now as opposed to waiting until they find out what that number is going to be?
Yeah. I think that's what's creating part of the swell, or has created part of the swell this year, was after the election last year. A lot of doctors that were within a couple of years of selling their practice came to us and said, "Hey, you know, I need to sell now because this could possibly cost a heck of a lot more to sell, you know, a year from now than what it could cost now." You know, if there's sellers out there right now that are on the fence, my advice to you is, if you want to get a transaction closed by the end of the year, we need to find you a buyer in the next couple of weeks, because quite honestly, everybody's getting bogged down with the backlog of deals that are currently in process. You know, the dental attorneys that work on these things are the biggest choke point, if you will, and they're backed up. It's not their fault. They're, you know, working 12-hour days, 6-7 days a week right now, trying to keep up with stuff, knowing that, you know, there's a lot of deals out there that need to get closed by December 31st, or that's the wish, is that they close by December 31st. You know, so getting something done right now is going to be difficult. But if there is somebody out there that's sitting on the fence, you know, now is the time to get on it and get going right away to try to get something closed by the end of the year. But it's definitely driven a lot of transactions this year from a seller side, because like Lee was saying, if capital gains, if you're currently sitting at a point where maybe you're paying 25% in capital gains, and that could increase to 40%, and 80% of your, say you got $1 million practice that's selling for $800,000, and 80% of that's going to goodwill, your tax bill is going up significantly in that scenario. But it's something that, we're being where we are, we're almost in October. Selling a practice in 3 months can be done, but it's not easy to do.
It's one of the reasons why I encourage a lot of these guys. I'm a little curious as to what the capital gains implications would be in a scenario like this, but it's the same way in my business, how I transition. And that is by allowing, let's say I've got a practice and I've got an associate in there, is allowing that associate to buy pieces of the practice from me over time, rather than doing one big transaction at some point in time. Couple of advantages of doing that is, A, you mitigate the capital gains liability. Second thing, to an extent at least, the second thing, actually, I'd be curious. Yeah, I'd be curious to get your input on that, Lee, because a practice sale is going to be a long-term capital gain, correct? Not short-term.
The goodwill portion of it is, if it's an asset sale, and if it's a stock sale, though.
Yeah. So let's say I have a dental practice. I sell you 30% of it, and I finance that to you over 5 years. That's still income. I'm being basically taxed on the income. So I'm being taxed at whatever my tax bracket is, not the long-term capital gains rate.
No, you would be taxed at your capital gains rate. You're either going to sell a percentage of stock, or you're going to sell a percentage of assets. And the assets is going to include some goodwill value. So either way, that's going to be some capital gains.
Okay. Okay. So a couple of things that happens there is you control, or at least mitigate to an extent, the capital gains liability. But an invested associate is going to be a lot more incentivized to produce and help make decisions and, work harder and grow the business and all those kinds of things. So each increment of the business that you sell is theoretically going to be of higher value than the previous increment that you sold. And he or she is helping you to increase that value. So we've got a merger acquisition, one of these coming up in a few weeks, if we can talk about that more there. So there's some creative ways to structure those. So the goodwill portion of the practice sale is going to be long-term capital gains.
Correct.
Matt, what are you seeing on the transition side when the transaction takes place? What are some of these folks doing to mitigate their losses? Mitigate their capital gains liability. I know with COVID, we saw some holdbacks and we saw some seller notes and we saw some creative stuff there. But are you seeing any of that strictly for the purposes of mitigating capital gains?
Currently we're not, because we're still under the current tax code. There's been, I know and Lee can probably speak to this more intelligently than I can, but I know that what was proposed recently, I think they were going to make it retroactive back to like September 15th or something along those lines. And we don't know if that'll pass.
April 14th was the date that originally they talked about making it retroactive back.
April 14th.
Yeah. And it's changed, and again, it's politics, and it'll get kicked around until they pass something or don't pass something. We don't know.
Right. Yeah. So right now we're not necessarily seeing it. We're more seeing the plan of action being, I want to get this closed by December 31st, in hopes that when this new tax package is passed, or if it's passed, is in 2022 and it's not retroactive. Hope's not a great strategy. At least that's what I was taught years ago. But, I haven't heard nobody's come to me and said, hey, we've got this great strategy to try to get around or defer capital gains. Lee might have some ideas out there, but as it stands right now, most of my clients that have come to me, the whole goal is let's get this sold by December 31st and then kind of see what happens with the current tax policy that's out there.
One thing that I don't know right now, and it goes to the point that I've talked about a little bit earlier, is potentially we have capital gains rate being higher than ordinary income tax rates. So we could see some shift of, pretty commonplace to have a 80% value to 85% value on goodwill. Maybe that goes down if tax policy changes, so that the ordinary piece of that is taxed at a lower rate. We'll just have to see how that falls out. And again, if it even happens. 2022 is a midterm election year. There could be a lot of more moderate Democrats that don't want to have a major sweeping, very wide sweeping change to the tax code that would impact a lot of people. So it's that crystal ball thing, and it's politics, and a lot of things are being kicked around that we don't know what will happen. Going back to this though, inflation and the amount of money printed at some point in time in the near future, it doesn't matter who is in office, we're going to have to deal with the money that has been created and put into the economy. And that's going to be through tax policy is the way it's going to be recovered.
Let's switch over to real estate really quick, because there, as I mentioned early on, there are some exemptions. I don't know if there are exemptions available to business owners who sell businesses, potentially. But I do know on the real estate side, and I don't know if this is just on residential property, Andrew, or if this is on the commercial side too. But on residential real estate, if I own, and this is a capital gains exemption, if I have a capital gain in excess of say $500,000, then there's a one-time exemption. Lee, correct me if I'm wrong. There's a one-time exemption. If I'm single, if I'm just a single person and I sell a house and my capital gains is $500,000, there's a one-time exemption up to $250,000. So I could sell the property and at least $250,000 of that I would not be taxed on.
Residential, that is true. On a personally owned piece of property, that is true. For a single filer, it's $250. For married filing jointly, it's $500. What they're talking about in the tax law and what we deal with from time to time, not too much in the dental world. I've not seen it happen very often, but when there's real estate involved in a lot of transactions for some more of an investment standpoint, there's a 1031 exchange where you can defer the entire gain into the next piece of property. And you might do that 2 or 3 times over your life. And your basis carries forward, and you eventually have a much bigger gain because you've deferred those gains over years to come. And the current proposal is to limit that to $500,000, which means if you had $1 million gain on a commercial piece of property, you potentially could do a 1031 for $500,000, but you'd still have taxes to pay on the other $500 or more. Mm-hmm. And I think that will could have a significant impact on the giant real estate investors.
Yeah. And that's only on the residential side, not on the commercial side?
No, that is on the commercial side. The residential is $250 and $500 for single and for married filing jointly. They're not talking about messing with that. From everything I can see, that will continue to go forward. But on the commercial side, there is no exemption.
Okay, and the 1031 exchange that you just described, that's on the residential side, correct?
No, that's on the commercial side.
That's on the commercial side. Okay, so the exemption that's available, and by the way, there are 3 criteria that you have to meet. You have to have lived in the house as a primary residence for 2 out of the last 5 years.
2 out of 5 years.
You have to be the owner, your name on the deed, and then you can't have used that exemption within the last 12 months. And so you qualify for that.
You can't live in 2 places
Right.
and do that.
However, if you don't meet that criteria, there are two other additional stipulations there that are available to you. If you have to relocate for medical reasons, for example, if you've got a breathing disorder or something, and your doctor says, "Hey, you got to move out west to get away from this humidity," that could potentially still qualify you for that exemption. Or if your job relocates you and you move, I think it's 50 miles beyond where you're an additional 50 miles away from your job. You cannot meet those criteria and still qualify for that exemption. And then the 1031 exchange that you mentioned, that is on the commercial side. So if I own commercial real estate, I can defer the capital gains to future properties. And then the current concept being discussed now is limiting that to $500,000.
That is correct.
Okay.
And it goes hand in hand with the raise in the capital gains rates. They're trying to generate additional revenue to pay for everything that's been done. So obviously, if you have capital gains property available and you can defer that and hope that another different administration may go back to lower rates, you can defer that. And that's not going to line up with the policy that they're trying to do. So they're going to force you to pay some portion of that in taxes if that does in fact pass.
Okay. If I own
on those 1031s, I know Lee can probably speak to them as well, but there's documentation and identification time periods and closing time periods that all have to be tightly documented if you were going to 1031 it. And there are consultants out there that kind of specialize in that.
Absolutely. Yeah. You definitely need to, if you're going to do a 1031, you need to use someone as a third party intermediary that has done it before and done it often, because it can be very tricky to make it all work.
So if I own a piece of real estate, I don't think it would matter if this is commercial or residential. And let's say it's a $500,000 piece of real estate or $1 million piece of real estate. What makes the most sense for me? Let's say I just sold my practice. I hooked up with Matt. Matt helped me sell my practice. I got 275% of the previous 12 months because Matt negotiated that for me. That was supposed to be a joke. He didn't. Didn't even crack a smile. So he'd be pretty good if he did that. But let's say I want to do the real estate separate. I could sell the real estate. And I'm trying to avoid capital gains, right? So if I sell it outright, then I've got a big chunk of tax that's owed to the IRS. If I own or finance it, that's one strategy.
That doesn't change the taxability of it. It's just a different revenue stream.
So here's my question: if I do that, if I own or finance it, at which tax rate am I being taxed on? The long-term capital gains?
Yes.
And I'm
does not change the character of the sale based on the
right. So if I own or finance the piece of real estate over 20 years, and let's say the note payment's $2,500 a month, then my long-term capital gains rate 20%. Then I'm paying 20% of the $2,500 of taxes.
Over the period of the 20 years that it's financed, you get to recognize a piece of that. That's called an installment sale. So it's not all recognized up front. It's recognized over the life of the loan.
Okay.
If it's paid off early, refinanced for any purpose by the buyer, then you have the balance of the capital gains due at that point in time. And
the same thing would be true with the practice sale.
Correct.
Yeah. So even if it was a portion of the practice. Okay.
Correct.
And then, so my only option, if I want to avoid capital gains, the only option that I've got is to lease the piece of real estate as opposed to selling it.
Yes, that is correct.
I would still pay income tax on the lease, release revenue, but I wouldn't create a taxable event. Okay.
You can create a taxable event, but it's just, yeah. It's
not a transaction. How do I phrase that? I'm not being taxed on the sale of an asset. I'm just being taxed on the income that's being generated from leasing or renting the asset.
Correct. And you may have enough depreciation to offset that income that you wind up not paying tax in the current year. But that's on a case by case. individual basis. If you own the building for 30 years, it's not going to be much depreciation left on it. Versus if you've owned it 7 years, there's going to be a significant amount of depreciation.
Are you seeing multiple instances where the practices that are selling are trying to have separate years for taxable events? I feel like I've seen this in a number of the smaller markets, maybe not as much here in Atlanta, but where they sell the practice in 1 year and wait till January 1st or some set date in the following year to.
Most of what I see, Andrew, is it's generally longer than that. It's probably 2 to 5 years out when the real estate gets sold.
If they don't sell it all at once and be done with it.
They don't sell all at once. And I don't think I've done a deal where it was all sold at one time. Honestly, it's been at least a year difference most of the time, if not 2 to 4 years difference.
Yeah, I can tell you, Ryan, my business partner, and I think in the last 12 months, we've sold 32, 33 dental practices. And I can think of one that we sold the real estate with the practice out of those 30. We've done some. We did one last December where we closed the practice on December 31st and closed the real estate January 1st for that exact reason, just outside the tax. But I think what we're seeing this year is we're actually seeing more people that would like to sell the real estate with the practice this year because there's so much uncertainty about capital gains next year. The problem is that, if you've got a younger buyer coming in, a lot of times it can be difficult for a bank to get comfortable with letting the buyer buy the practice and the real estate together. They want them to wait a year before they'll allow them to do that. But on the flip side, practices we sold last year, we're seeing those sellers wanting to unload that real estate this year because of the uncertainty about what the taxes will look like next year. So yeah, I think I agree with Lee. It's been interesting with the real estate sales. We do have one that we're closing before the end of the year where it's 2 practices, 2 pieces of real estate. However, that's a REIT essentially buying the real estate and a DSO buying the 2 practices. So we do see it still, but it's definitely, things are getting structured a little bit differently. We're also seeing with some of the REITs that are buying real estate, and this is something even for current practice owners to maybe consider and talk with, their team about. For example, their CPA and their real estate broker is if they want to unload the real estate now, hold on to the practice for a while because maybe they're concerned that the real estate, they don't want to be a landlord post practice transition. These REITs that'll buy them will sometimes roll a portion of the purchase price into equity for the buyer. So almost similar to what we're seeing with practice sales. So let's say the purchase price of the practice is $1 million or the building is $1 million. They'll come in and buy it for $1 million. They'll bring $800,000 cash at close. They roll 20% of that purchase price back into equity. So they've still got some equity. They're still getting some checks from the practice. But then when they go to sell it 2 or 3 years, the other 20%, it will have appreciated in value. There's some gain financially for them. But they've already got that portion taken care of before they get ready to sell the practice. And typically, when we get involved with those, what we want to do is make sure that REIT is buying it at a cap rate, that lease rate is not going to negatively affect them when they go to sell the practice based on where their current revenues are.
Very good. Very good. So I'll make this comment with respect to time. Obviously, if I'm a dentist and I just opened my own practice and I've never done a crown, on my own before, I'm not going to call my buddy down the street and ask him, what do I do with this patient that has this issue and I need to do a crown, right? I'm going to call somebody, or I'm going to get somebody who specializes in whatever it is I'm potentially doing. And so that's one of the reasons why I've set up this series of virtual events, and the people that I brought into the fold here on these events are more or less what I would consider like a virtual board of directors. So as a CEO of a dental business, it's important that you have resources that you can tap into to bounce questions off of, to make sure you make effective decisions. Because based on everything that we talked about tonight, I think the general consensus is no one has a crystal ball. No one knows what the future is going to be. And in order to make sure that anyone is successful as an entrepreneur, 3 elements have to exist. You have to be smart, flexible, and quick. And so there are areas that you need to be smart in that there's just no way that you're going to be smart in. For example, I'm not going to be an expert in real estate like Andrew. I'm going to know enough to know that I don't know enough. I'm not going to be an expert in transitions like Matt. I'm going to know enough to know that I don't know enough. And as CEOs or as business owners, we need to recognize where our strengths are and where our expertise is and where it is not. And we need to make sure that we surround ourselves with a team of people that have expertise and experience in areas that we don't, so that we can make the most effective decisions possible. The benefit I would say, and I would just provide this quote, and that is, the only thing better than learning from my own mistakes is learning from someone else's. Okay. So the guys on this call, the guys on next week's call, the folks that I've had on previous meetings like this, have tons of repetition, trial and error, experience after experience of situations that turned out really good, situations that didn't turn out very well. So leverage their expertise so that you don't have to recreate the wheel and make mistakes and learn from your own mistakes. The whole purpose of this series of events here is to expedite the process and make the path more efficient and easier for folks that are in practice ownership or trying to get to the next level of practice ownership, or who are considering practice ownership. So with that said, I appreciate everybody tuning in this evening. Again, this has been recorded, will be available on YouTube. I will also be sending out, or Brittany will be sending out CEs to those in attendance. And then we'll also be sending out an email with a link to the recording to everyone who registered for the event. Gentlemen, I appreciate you spending some time with us this evening. As always, wealth of knowledge. Grateful to have the opportunity to learn from you. And we'll have to do this again pretty soon.